Hi, I'm Kevin Wright here, back with another property finance tip. So what is it this week? It's about limited companies. When's the right time to buy using a limited company? And it's not quite as simple as, hey, I'm just going to be able to use the interest as a business expense. It's more complex than that. So keep watching and I'll explain why. So, limited companies, buying a limited company. Everyone's saying, buying a limited company, is that right? Well, not necessarily. Let's drill down and look at some of the detail here. Now, right now it's true that mortgage interest as an allowable business expense is no longer possible if you own a property in your personal name. But it is still possible if you own a property in a limited company name. So therefore, it should be obvious, shouldn't it? Well, let's buy in a limited company. And in fact, there's a big knee-jerk reaction of people that are sometimes brand new into property saying, oh, well, I've got to buy in a limited company. But is it quite that simple? Actually, no, it's not. So let's look at why you might still choose to buy in your personal name. First of all, the business relief you would get is influenced by the rate at which you pay tax on your normal earnings. So you can be a basic rate taxpayer or a higher rate taxpayer. Now, higher rate taxpayers are going to benefit from the most tax relief. Now, one point I want to make very clear here, I'm not an accountant and I'm not qualified to give tax advice. And this isn't tax advice, this is just information. And I'm going to give it to you from both sides. So you do need to get tax advice, but you also need to get mortgage advice as well. I'm going to explain why. Higher rate taxpayers clearly save more by being able to write off mortgage interest as a business expense than basic rate taxpayers do. But there are other things to consider too. Now, an accountant generally is going to charge more to prepare the accounts of a limited company than they would as a sole trader, which is what you would be if you were buying properties in your own name. So, against the tax saving that you're going to make by being able to use your mortgage interest as an allowable business expense in a limited company, you're going to have to weigh against that the higher costs of preparing accounts. Now, your accountant would give you a comparison of the two. It's this much as a sole trader, it's this much to prepare accounts for a limited company. So you need some clarity on that first of all. And what you should ask your accountant is, in a full tax year, how much money am I going to save in tax by using a limited company as opposed to continuing to buy in my personal name? Once you've got that figure, great, you've got one half of the equation. Now you need to get the other half. And the other half is you now go to a good whole of market mortgage broker and say, right, how much is it going to cost me extra to buy properties in a limited company? Because the fact is you're never going to keep 100% of the tax saving that you make, because your mortgage costs of using a limited company are going to be higher than if you used your personal name. So, and that's because some of the lowest rate mortgages on buy-to-lets are only available to people that are buying in their own personal name. They're not available to limited companies. So there's an element of higher mortgage costs, and you need your mortgage broker to tell you, well, how much are they going to be over a full year? So the only time you can really make the decision that's right for you personally, and it is going to be different for everyone because everyone's got a different tax situation, and it's only when you can say, I'm going to save this much tax, it's going to cost me this much more in mortgages. Now, if you can still save more tax than you're going to pay in increased mortgage costs, great, buy in a limited company name. But if your mortgage costs are going to outweigh your tax saving, then clearly you're actually going to be worse off by buying in a limited company. And you should be checking this regularly, possibly every year, but certainly every 2-3 years, and absolutely every 5 years, to recheck those balances, because if you're adding properties to your portfolio each year, then the tax situation may change and your accountant may give you different advice. So it's wrong to rely on just a mortgage broker. It's equally wrong to rely just on an accountant's word on should you buy a limited company. You need both sides of that coin to balance the argument and to see whether you've got the right situation to benefit from buying in a limited company. Typically, larger landlords with sizable portfolios would benefit from buying in a limited company. The point is, it may not be advantageous for you to start off that way, buying your first 1 or 2 properties. There is no hard and fast rule for it. It is all down to what is your personal tax situation. The word here is, don't just jump into a limited company format as a knee-jerk reaction because you're going to save some tax. Drill down and find out the detail and see how much tax you're actually going to save and how much your mortgage costs are going to increase, and then make an informed choice. And I'll see you next week for another property finance tip.
If you enjoyed watching this video, did you know every Monday morning at 8:30 I do a live Facebook Q&A. So if you want to start the week with checking out some answers to your property finance questions, click the link here.